morning, everybody. I hope you had a great night, great breakfast, and you're fired up for the day. My name is Samson Achisia. I work for a company called Finbots.ai, and I'm the growth director. My objective is to grow the business for Finbots here in Africa. So at Finbots.ai, what we do is we help financial institutions to develop their own credit models using an AI tool that we provide to them. And the objective of that AI tool is to actually enable their lending business to be much more profitable. So as a company, we got founded in 2018. We identify ourselves as a B2B SaaS fintech, and we have got clients in Australia, Asia, Middle East, and Africa. And actually, we are also voted as a top 10 fintechs in Singapore by the Monetary Authority of Singapore. So we've got a very strong assertion to build these models, and then it takes a very long time to actually build, validate, and deploy model. In fact, financial institutions take up to 12 months to deploy a credit model. Furthermore, the models that are developed have very low accuracy or predictive power. In fact, most financial institutions are actually okay going to market with scorecards with Gini of 30-40%. We feel that by financial institutions going to market with scorecards that have got a very low predictive power, what that portends is the fact that they're actually experiencing very high credit losses that they shouldn't be doing. And then also, they are not confident to aggressively grow their loan book because of what? If they do that, the credit losses pile up. So, as a company, we solve all these problems by one of our products called CreditX. So pretty much CreditX is a platform that enables financial institutions to rapidly develop high accuracy credit scorecards. Fully automates end-to-end the process of developing credit scorecards. And I must say, we are the first in the world to actually do that out of the box. And given the fact that the whole process is automated, it means you can develop your credit scorecards at record time. To give you an example, in Asia, there was a credit bureau that provided us with a data set that had 1,600 variables, 500,000 loans, that is 800 million data points. Guess how long it took us for us to develop a model using that data set? It took us a mere 2 hours to do that. If I had given that data set to a data scientist, they would have taken months to do it. That's the power of AI. Also, the solution the tool that we have, the models that we develop are not a black box. They're explainable. It's based on explainable AI. What that means is that at the end of the process, our tool will provide you detailed documentation concerning the model parameters, the model variables, and also it provides you detailed reports concerning the model validation reports. So the tool is able to give you all the data to enable you optimally use the scorecard that we develop. The other aspect is got inbuilt compliance and governance modules. That means you can track, audit, and control all the activities that happen within basically our tool. And to put the icing on the cake, it's extremely easy to use. It's got a no-code interface with probably 12 clicks with your mouth. 12 clicks with your mouse, you are on to the journey of developing a model. In Nigeria, for example, we have a CEO who has got no background in data science developing credit models with Ginies of 80%. And given the fact that our solution is able to enable a financial institution to develop credit models with very high predictive power, our customers have been able to experience credit losses going down by 15%, approval rates going up by 20%, and even some of our clients also use our solution as a decision engine. In that case, they are able to actually get whether to give an individual a loan or not at a record time of a quarter of a second. So how does the solution work? So one aspect about this solution is that you just need to prepare the data and have it stored somewhere. It could be a data lake, it could be a data warehouse, a database, or even if you're rudimentary, you can even have it as a flat file like a CSV. All what we need to do is connect that data source by API and for a tool to pick that data. Once you have an API connection to your data set, which our tool is able to ingest that data, and then we're able to do data treatment. Data treatment is where most data scientists spend a lot of time. And I'm happy to say that our toolkit does data preparation in an automatic way. It's able to do standardization, transformation, content coding, bias reduction, handling missing variables. It's able to do that all automatically in record time. After that, it's able to do feature engineering automatically and pick up all the variables all the features that are predictive to your data set. Then after that, it's able to develop multiple types of models, and using our in-house algorithm, it's able to pick up which is the best model. And we pick up the best model using two indicators. That is predictive power and stability. It makes no sense for you to have a very high predictive model, but at the end of the day, that model is not stable. And with a click of a button, you're able to deploy that model. So the output of the model can be sent to your loan origination system, whereby we're able to provide you the PD, the score, and all the variables that made a particular application to be accepted or rejected. Or if you've got a decision engine or core banking system, and you want the actual model to be exported, our AI tool is able to do that by exporting the Pickle file. So this whole process takes around 6 to 12 months for a traditional bank to actually do, from development to deployment. From development to deployment. In our case, using our tool, we reduce that amount of time to a whole week. Really, that is actually our competitive advantage. So our tool has been developed in such a way to meet the AI fit standards according to fairness, explainability, accountability, and transparency. I just want to delve just a bit on fairness. So our AI tool builds credit models from the ground up. You give it data, it makes sense of that data, and develops the models from ground up. We don't provide model templates. We don't provide you with expert scorecards. We don't provide you with generic scorecards. What that means is that our solution removes bias. Our solution kind of like relies on data science principles to develop for you a model that has got no bias. Also inbuilt into the solution, we have strategies that, or actually methodologies within the model that remove biasness from data. We have strategic alliances with one of the top global reputable firms in the world, and what that has done is it has gone along to validate that what you're doing is actually what the market needs. And social not actually in this slide is IFC. IFC, we work closely together with them, financial institutions that they invest in. So we have customers, different types of customers. For example, we have consumer lenders, SME lenders, fintechs, digital banks, and also credit bureaus in Asia, Asia Pacific, Middle East, and Africa. What that tells you is that our solution is tried and tested across geographies and across different types of financial institutions. So pretty much what I've just said today might seem too good to be true, but we actually believe in our solution. So if you're a financial institution that wants to develop high accuracy models, I mean models not to the gene of 30-40%, but genes with 80%, we can prove that concept, we can prove that to you.
Growth Director for African Green
for that excellent presentation. And in the interest of time, I'll just start. We've heard what AI can do to support credit scoring. So I want to take us back to innovative development in credit scoring and what that really means for the two of you. So I'll start with Kevin, just so that I can give you the opportunity to introduce yourself. I know you wear many hats, chairman, serial entrepreneur. So maybe you can introduce yourself first and then take the question.
Good morning, everyone. My name is Kevin Mutiso. As Juliet just said, I wear two hats. I'm the chair of the Digital Financial Services Association of Kenya. I always have to tell people it's a mouthful. We are basically the industry association that has been advocating for progressive regulation that focuses on consumer protection and has sort of dealt with some of the bad practices. And I've seen a few of my members here, Felipe and Duncan, and I've seen future members as well. The other hat, which is what I love doing, I'm an entrepreneur. We're building a platform for Boda Boda riders. What we currently offer them is personal accident cover, free, for every 90 liters of fuel they consume. We give them an interest-free loan for 24 hours to purchase fuel. We give them third-party IPF financing to buy third-party insurance and comprehensive insurance. And we now have over 20,000 riders on our platform in Nairobi. Thank you. What I'd say is one of the biggest things in the last 2 years or 3 years is the aggregation of different data sets into a single point of, single place, so that you can then scrape all that data and use it for data scoring. One of the biggest challenges we've had is collecting payment data or transactional data. And you now have solutions that are able to give you bank statement data without having to integrate with any of the banks, without having to ask the customer to send you bank statements to you. And so that type of data has become very relevant and useful in credit scoring. I think the other interesting thing is stuff like what Samson just presented, where you collect all the different types of data that your customer allows you to collect on them, and you start building predictive algorithms to tell you whether the client or the customer will be able to should get a loan or not. Now, I'd sort of say those are the two main things in the last 2 years.
Okay, thank you. I'll come to you, Samson. I can only imagine approaching traditional financial institutions and talking about AI. So where do you start, and what are some of the challenges that you face, even as you sell to them this proposal around AI for their credit scoring?
Yeah, definitely. Definitely there's some challenges, and one way when people hear what AI, the first thing they actually think about is the fact that This is something very new, it's very complex, and most importantly, it's a black box. We don't understand what these algorithms are telling us. And actually, in actual fact, that's the truth. Most AI models actually black box. And the reason why they're black box is because they perform extremely complex calculations which human beings cannot actually fathom. However, there's a field in AI called explainable AI, whereby data scientists are trying to ensure that models are able to produce outputs that can be explained. So we tell these financial institutions, there's no need to worry. We can provide you with models that are actually explainable, and you can make sense out of that. The other aspect, the other challenge that we face is in terms of manpower. AI, it's a new field, it's a very technical field, and yes, there are data scientists around, but then you find that these data scientists don't have domain knowledge in credit risk. So you can have somebody just graduated from, let's say, from Staffmore as a data scientist, but if you take them to the bank, they can't provide value immediately because they don't have a kind of like knowledge or domain expertise around credit risk. So that's one pretty much of the challenges that we face and our solution is able to overcome. So I'd say those are the two key aspects. That used to be the case, but right now, most financial institutions are actually sitting on a wealth of data, both structured and unstructured. And given the fact that these days, most customers of financial institutions have a very rich digital footprint, we feel that's, again, is a very rich source of data. So access to data is not the issue. The issue is how to get that data and transfer it into your computer systems so that you can actually use that data. So I feel that's where the challenge is. For example, you're doing SME lending, and the kiosk person gives you a PDF of a bank statement or an invoice that is written which is handwritten. The challenge is how to transfer that data to your system. And the beauty about it, there are AI tools that are able to do that. And we feel going forward, that challenge of transferring data which is available out there to be into your computer systems will be much more easier going forward.
Thank you. Kevin, I'll come to you. When you think about lending, it's changing, especially there's a consumption lending, moving out of the system and into what I call hidden debt. I think Maurice talked a little bit about it yesterday around even kiosk credit or store credit. We're having embedded finance, buy now, pay later. So that is credit or access to credit that's not really captured possibly within your traditional financial institution. So how then can we possibly leverage on technology to be able to capture some of this data that's outside this system?
Well, a lot of these consumption products are relationship-based, and so if I walk to a kiosk and the kiosk owner gives me credit, it's because he or she has seen me live in the neighborhood for a long time. So the first challenge there is how do we identify those relationships in a given community. We would then need to offer the kiosk owner some form of solution that would enable them to track these debts that they give to their customers, and then that data will then now be aggregated by somebody, say like the bureau, to then sort of give that additional data set to lenders like us, who want to then give the customer some form of credit facility. The question here is that will it be commercially viable, right? So I suspect that in the short and medium term, no. It will take a lot of capital to sort of build a network of kiosks and vendors to aggregate that data to make it viable in the long run. So that would then be the second problem. Are there value chains that potentially would not need that amount of time? I think the answer is yes. And so what we would be focusing on is what value chains are those, and what are the ticket sizes? So yesterday, for example, on the panel that I sat on, we spoke about cement manufacturers, for example, who, if you know, cement is the second most used commodity after water in human life and in life in general. And so that sort of tells you that there are many suppliers into a cement company, and there are many payments that are happening, and there are many transactions. And so if somebody was able to aggregate all the data that happens in that ecosystem, you'll be able to capture several SMEs and give them more appropriate credit in the long run. And it will take a much shorter time because you don't have 1,000 cement companies, you have 3 or 4, and so it will be a lot quicker and the investment will be less. And so I think to answer your question is, start with a value chain that doesn't have many players in terms of many big, many points of data. Maybe have something like the cement ecosystem where you have 4 players, and then work on one, figure that out, and then cascade that into different sectors.
Sure, yes, definitely. So some of the best practices that I can mention when it comes to using of credit scorecards is, first and foremost, build your PD models or probability default models, but use them in conjunction with macroeconomic models. This is very critical because businesses don't operate in vacuum. They operate within an economic context. So using macroeconomic models to a large extent enables you to consider those factors. The other best practice is to use these credit models in conjunction with business rules. So you can have a very fancy credit model based on AI, Ensemble ML, etc. But that model has some deficiencies. It cannot take into consideration your business strategy. It can't take into consideration the regulatory requirements. Therefore, best practice entails you to use your fancy credit risk model in conjunction with business rules. Then the other best practice, which I would encourage, is to have a fully digitized onboarding process, and also to maximize on the amount of data that you collect during the onboarding process. You should not be the person to decide this data is good, this data is bad. Just collect as much information that you can. For example, we have a client that is using chatbot information from their chatbot into our AI tool. Most likely we see the data and like, okay, probably chatbot information might not be predictive to risk, but let that decision not come from you, but let data science dictate which features, which data points are actually useful or not. So those are I'll say, the top 3 best practices that I can think of right now.
Okay, thank you. Just possibly one more question to Kevin, and I can open up to the audience. And this is on something that was also in Samson's presentation around algorithmic bias. So much as we are moving towards tech and leveraging tech, there's still human bias that comes into or can come into this credit scoring model. So how then can we be able to mitigate this bias?
It's a tough question. It seems easy. I think it's part of human nature to be biased about some certain things. And so if you want to solve for or eliminate bias in an algorithm, you have to be aware of the biases you have as whatever role you play in that ecosystem. If you're the data aggregator, if you're the one putting the algorithm together, if you're the one feeding the data into the AI engine. Identifying bias is difficult because bias is basically programming. It's that part of human programming that we all have. And so I think the first thing that would likely need to be done is not have a single point and have a group of people that have probably different attributes to balance it out. So what does that mean? If you are in a company, maybe have a male perspective and a female perspective. If it's, there's another bias of, age, is maybe have a younger perspective and an older perspective. At the end of the day, what really matters, the question the business always has to ask itself is that, is it commercially viable? So the other question you would need to answer is, how far do you, or how much work do you want to do to manage the bias? And so you need to also know the limits, because after a certain point, it might be counterproductive to the business. And so it's a very difficult question to answer, but I think the best way to solve for bias is have, say, a committee of decision makers managing each other's perspectives, so that every nuance and every different attribute is captured by the different perspectives in the community.
I have a question to Samson. First, thank you for a good presentation on Finboard's AI. I've looked at your model, Creditex model. I'm thinking about solving two problems using that same solution. So you can have the model give you a credit scoring output, which you then adopt to apply credit limits to your specific customers. And then number two, fit these calculated probabilities of defaults to an expected credit loss model, an ECL model, so that you're able to, for regulated financial institutions, you're able to solve compliance requirements to certain standards like IFRS 9. So you solve the problem of credit scoring and also the same model for financial regulation compliance. So have you adopted or thought about incorporating the element of ECL computation from the same model?
So two questions, one to Samson, one to Kevin, very simple. So to Samson, your solution is very interesting, but I didn't see any Kenyan customers there. And the three challenges you mentioned, I thought the budget would be one of them. So budget is value for money, so I guess that's not an issue. I'm just curious to know how much that solution would be for a typical bank ask. And then to Kevin, I thought so. So I don't know if it's revealing your trade secrets, but I'd be curious to know about your Boda Boda solution, how you do the credit scoring, whether it's for the fuel or the insurance solution. Thank you.
On the border side, but if I can move back to the digital financial side, your other hat, as it were. Can you talk maybe about the initiatives that are going on between the DFS and your role as chair to promote alternate data sharing with the regulated bureau sector? And what's happening or what's not happening, and maybe what needs to happen, to kind of come back to the theme of the whole conference, is to, you know, it's really about where's that alternate data within the digital financial space. That's where the data is, or a big part of it, and what are the things that need to happen to catalyze that data sharing?
What comes to your mind is it's very expensive, and actually it is. If you look at AI tools out there, they cost $1 million plus. But the fortunate aspect is that our solution is not expensive, and since it's a toolkit, we've got a licensing model. That means you pay once for it, basically during the whole year. You pay for it only once, and during the whole year you can use it as many times as you want, and with as larger data sets that you can actually have. So there's no variable cost into it. However, in my experience selling the solution, especially in Africa, most financial institutions prefer a per-use model. And I'm happy to say that we are able to provide such a pricing model whereby we charge you per score or how many times you use the solution. So in that regard, we are quite flexible. In terms of our costing aspects, that impact our costing are actually about two aspects. The number of pipelines or products that you need to score, and secondly, what type of credit models do you want? Do you want origination credit models? Do you want collection credit models? Do you want behavioral credit models? So for a particular financial institution, they might have 3 products. But for out of the 3 products, 2 of the products, they only want a behavioral score, credit scorecard. For one of them, they want an origination scorecard, and then and for all of them, they might want basically a behavioral score. So it's quite a complex matrix in that regard, and therefore our pricing is usually highly customized, highly customized. And then lastly, our solution is very useful for, it can be afforded by fintechs. Like in Nigeria, we have a fintech that is just raised our Series A funding, their Series A funding, and they are able to afford us. So I'd like to just let you know that our solution is it is quite affordable and commensurate to the value it provides to you.
Thank you, David.
Geraldine,